I'm Jagir. Today's video, we're going to cover Fibonacci ratios. It's one of the most powerful things, especially when you combine it with Elliott wave theory. It allows you to project forward into the future, which is referred to as a leading indicator on what is likely to happen next with the price action. So you can make a better investment decision when you're buying, selling, or even considering buying. So you want to always put the probability in your favor so you can maximize your returns. If you're wondering, who am I? I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro. If you like today's lesson, hit the like button, subscribe, hit the bell notification, because I want to bring you these daily nuggets that make this complicated space of crypto, blockchain, investing, technical analysis, and simplify it so you can get up to speed so you can leverage this new technology as a user of the tech, but also as an investor of the tech. So let's dive straight in. So Fibonacci, this guy is a clever guy, but I want to kind of read you a couple of things to kind of get you up to speed. So the thing that we're looking for is when there's a coincidence of time, price, and pattern, and I'm going to go into this a bit more detail with particular Fibonacci ratios, trend change, which is like when the market of the movement is trending up. Trend change is when it trends down, or if it's trending down, the trend change is when it will change direction again. It's highly probable when a market trades into a time, price, and pattern zone. I'm going to cover that in a bit more depth in a second. So Fibonacci ratios, a series of ratios related to the root ratio of 1.618, also called the golden mean or divine proportion. So it's a series of ratios related to 1.618. These are the most prevalent ratios found in all forms of natural growth processes, including the process of mass psychology. Now, people often ask me, what drives the markets? Why is the price going up? Why is it going down? Well, fundamentally, it's going up because there's more buyers than sellers, right? If there's more people buying something than selling, the price of anything goes up. If there's more sellers and more people are selling than buying, the price goes down, right? And a big part of that is speculation, fear and greed, the emotion of fear, uncertainty, and doubt, or euphoria. Yeah, so that's really important to understand. So I'm gonna kind of recap. In one of my previous videos, I covered Elliott wave theory, which is the basics, the real high level. And typically, it runs into 5 waves and subdivisions. Now, I'll put a link in so you can have a link to that video. If you haven't seen it, I would recommend that you go into that video first, because I just go into the basics of Elliott wave theory. But I want to talk today about how we can combine that with Fibonacci ratios, which at first, everything is difficult before it is easy. If this is the first time you're seeing this, it may look a bit complicated, but with a bit of practice, it actually gets relatively simple, but more importantly, powerful, especially from an investment perspective, because you can minimize your risk and maximize your upside. So what we're going to talk about today is something called the wave 2, right? So you saw a wave 1 and then you saw a wave 2. Why wave 2? Well, wave 2 is one of the most powerful, highly probable areas to invest for the maximum upside and the minimum downside. There's a famous guy called W.D. Gann, and he's like an old school investor, trader, technical analysis, and he's really into the psychology of the markets. And what he said is, one of the safest times to enter a market is on the first reaction against a new trend. First reaction. So there's a new trend, wave 1, and then the first reaction is the wave 2. That's one of the best times or the safest times. You always want to minimize your risk and maximize your upside. So we know it's 1, 2 is typical Elliott wave for the first wave, and wave 1, just to make it crystal clear, breaks down into 5 waves typically. And the wave 2 breaks down into an A, B, C correction. So we're looking at pattern. So we know wave 2 is what we're focused on. So let me just bring up my laser so I can make this crystal clear for you. Because once you get your head around this, this is so powerful because you want to look for this pattern, this A, B, C correction. And it's referred to as an A, B, C, and it's 3 waves. Price. This is where I'm going to draw. If you're brand new to Fibonacci, there's some brilliant software out there. TradingView is one of the best ones. That's free, or there's a free version of it that you can apply what I'm about to show you. So price. So typical minimum retracement of price is 50% of wave 1. Why'd you get what you said this is going to be in English? I did, right? So wave 1 is this movement. So it's going to be, there's a price movement here. It's gone up this much. And then it tends to correct wave 2. So it moves back down 50% of wave 1. So to make that crystal clear for you, here is 100% of wave 1, right? So you got this price movement up, and then typically a wave 2 corrects a minimum of 50%, right? So we can project that forward and go, right, if we are confident a wave 1 is finished or looks like it's finishing, there's a correction happening, we can anticipate that the price is going to pull back a minimum of 50%. The maximum price that tends to be most typical, most common. Remember, there's no guarantees in the world of investing, but we can definitely get the probability in our favor and act with that edge and that probability over a long period of time, and that will serve you incredibly well. So the maximum is a 78.6. Remember, this is a ratio that's related to the 1.618 ratio, which is that divine proportion that signifies this mass psychology of the markets. So now we have this really kind of narrow price zone where we can be quite confident that when we're seeing a wave 1 high and we're seeing a correction, that the correction should finish in this price zone. That is powerful information that most people are unfamiliar with, especially because they don't combine it with Elliott wave theory. So this is powerful. Are you seeing the power of this? I hope you are, because this is high level stuff. I'm simplifying it for you so you can make it actionable and you can apply it to your investment strategy. But now it's a game changer, right? And the amount of time I've seen this in the markets unfold almost perfectly, that's helped me make really wise investment decisions on minimizing my downside and maximizing my upside, is this time retracement. So now we've talked about price, so wave 1 goes up and then wave 2 pulls back. Now we're talking about time, so we're going horizontal now. So usually 50% of wave 1's time as a minimum. So wave 2, the length of time it takes to unfold, we're going left to right, is 50% of the time taken for wave 1 itself, this part here. So let's just make this crystal clear. So wave 1, right, if we look at this, is 100% of the time of wave 1. Let's just say it was a month, right? 4 weeks. It's taken 4 weeks for this market to unfold a wave 1. What's 50% of 4 weeks? You got it? You got it? 50% of half of 4 weeks is 2 weeks, right? So we're going to project 2 weeks into the future now, which is 50%. So now we have this typical minimum time zone. So now this is so powerful. I know I've made it incredibly simple, but don't take that for granted, because now we have a minimum time zone, that typical wave 1. We want to be patient to wait for it to hit the minimum time zone and the minimum price zone. And if it gets into the zone, we then want to look for a high probable setup to go long. And this can be on a yearly chart, on a weekly chart, on a monthly chart. So let's just say we've seen a wave 1, but it's taken a year for that wave 1 to unfold. How long would a wave 2 take to do a correction? Typically, and the minimum, 50% of 1 year is 6 months. So we can expect this big correction of 6 months. And you often see that with cryptocurrency markets when we're in a bull market and then a bear market. This is so powerful. Well, there you have it. You've just gone to the next level on Elliott wave theory, but now combining Fibonacci ratios to Elliott wave theory. Now we've covered just wave 2, right? If you want to learn more about Fibonacci, Elliott wave, and how to apply it to wave 3, wave 4, wave 5, how to minimize your downside, how to, anticipate your exit 1, your exit 2, and what's the best kind of risk management, but also understanding the tech, understanding how do you find these early stage projects that have a 500%, if not 5,000% potential on the upside, and so on and so forth. I've actually created a masterclass for you. Yeah, it's called the Crypto Masterclass, How to Fund Your Retirement, and it takes you from A to Z, and I've just jam-packed it with amazing information, and it's free for you. It's in the link below. Click it, take it, love it, enjoy it, and hopefully it's gonna upskill you. Now, if you enjoyed today's video, hit the like button, subscribe, hit the bell notification, because I want to bring you these daily nuggets of education in this complicated space, because we're talking about tech, this new tech, with all this jargon. We're talking about investing in this new space, which is relatively high risk if you don't know what you're doing, but with proper risk management, different game. Technical analysis. I've seen people teach technical analysis, and I'm like, oh my Lord, why are they making it so complicated? It is complicated. However, Leonardo da Vinci said it best. The ultimate sophistication is simplicity itself, or simplicity is the ultimate sophistication. And we can simplify this so it's actionable, so you can feel comfortable and confident in using this new technology, because we are in this early phase it's called the S curve. We want to be in this early phase and use the tech, love the tech, because there's some amazing opportunities for you as a user of the technology, but also as an investor of this early phase of the technology. All right, I will see you soon in one of my future videos.